Hello there, welcome back to the channel. Welcome to another video where we dive into the YouTube 2025 mentorship that ICT is running right now on his YouTube channel. He's looking at a very systematic, repetitive approach towards the market, low-hanging fruit objectives, and an opportunity for you to find the 20 handle trades that I'm always striving for day in, day out, week in, week out. New day opening gaps, new week opening gaps, midnight opening range, 9:30 open, 3:30 a.m. trading, regular trading hours, electronic trading hours, fair value gaps. A lot of terminology is going through those videos, but I'm here to help. I'm here to explain, and I'm here to help you dive into the marketplace, not only using YouTube 2025 concepts that ICT is presenting, but my Picasso's fair value gaps, but also my trading strategies that are a little bit tiny bit easier to understand and easier to get started with. So where do you start? You have to start with realizing two very simple things. First, that the market is looking to deliver algorithmically, and it's going to deliver for two things only. It moves towards liquidity and it moves towards fair value. In this video, we're gonna talk a lot about the fair value. We constantly talk about that in my live streams, in my Discord community. So if you're not there yet, take a look at the description down below. The invite link is going to be there for you. We run every single live stream using the concepts that I'm going to be talking about. So if you're going to be interested, let us know down below. So the model that we're going to be diving into is going to focus on the latter, on bringing us the fair value. And if you're still going to be wondering why the market has stopped at the point that I'm going to show you in this particular video, you should leave a like to this channel, subscribe for more, because we're going to be giving you insights week in, week out. Then I guess without any further ado, let's dive in. So in this video, I wanted to talk about the midnight opening range and how to use it, how to approach it every single trading day. If you don't mind, we're gonna dive into the charts right away, starting with the most recent price delivery on Tuesday, the 4th of February. First thing first, I want to find the market opening at midnight, right? The market opens up here. I'm gonna extend this price to the right because the smart money is just gonna be using it throughout the day, okay? So we're gonna extend the midnight open throughout the day, midnight open. And second thing I'm gonna have to do, I'm gonna have to find the high and the low of the midnight. Midnight open range happens in the 30 minutes delivery from midnight open towards first 30 minutes of trading. So the range happens that half an hour right here, and we're gonna be looking to note the high, the midnight open itself, and the low of the dealing range. Once we get that down, I'm gonna be looking for fib extensions. I'm gonna be looking to find the high and the low point of that range. I'm gonna be noting the half standard deviation, one standard deviation. We're gonna be noting the negative half standard deviation and negative one standard deviation. So if we take a look here, we're gonna have, if we take a look here, we're gonna see the standard deviations of this range delivering higher, because the Tuesday trading we've been calling for higher prices. We wanted the new week opening gap to get closed. We wanted the market to trade back into the Friday's delivery, right? So we've been bullish, we've been looking for higher prices, and we're gonna extend this to the right because the marketplace is gonna be reacting towards these levels throughout the day. Once we find the midnight to first 30 minutes of trading price delivery as well, what I'm gonna be interested to watch is the first half standard deviation and the one full standard deviation above the marketplace, because we're looking for bullish prices simply. We can do exact same fib extensions to the downside, but we're not gonna use it for this example. Second thing for this model is we're gonna have to find the first displacement of the marketplace. First big rapid move of the marketplace that pushes, this time, the marketplace to the downside. So the first displacement is going to be here. We have two very big fair value gaps, so I'm going to just extend them to the right, and we're going to do exactly the same. We're going to use fib extensions here to look for how the marketplace reacts to these levels, okay? I'm going to change the colors towards these, and I'm going to put them in red just to see them a little bit better compared to what we're using for the midnight range. Okay, so red lines are going to be for the first impulse of the day and the fib extensions towards that, and the second line, the first Fibonacci extension, is going to be for the midnight opening range itself. Okay, and we're just gonna dive through both of them back and forth. Once we have the Fibonacci ranges, once we have the half standard deviation, 1 standard deviation on our chart, we're gonna go into price delivery first for London trading. Once we have the Fibonacci extensions, once we know the full-on range itself, we're gonna go into London trading. We come into the London trading, and London trading gives us few very interesting things that we're able to watch, right? One thing is you see how many times we react off the low from the impulse leg, right? You see how many times we react at the 50% level of it. And we don't really have any fib extensions because London has been consolidating a little bit. But take a look at what happens at 330, which for London traders, 330 is going to be the most important place in the marketplace. So we're going to mark the 330 macro, where we're going to just tag the first 10 minutes before 330 and after, and take a look how beautifully right here we find a entry that we can be using at the macro itself. So we have the 330 macro right here, and that 330 macro gives us a high here at the 50% level, which is not a random high, right? We can easily trust that. And not only that, we have an inversion fair value gap right here that gives us an opportunity to go what? To do what? To go short right here, right there. The stop can go above the high itself, and we're looking to deliver the sell side right below the market price, right? You could have tagged the dealing range itself from the midnight open, right? It's 50% of it, but take a look down here how beautifully the marketplace not only consolidates around it, which is again nothing random here, but also takes away its sell side resting down below. First opportunity from this model comes at 330. If you're looking to trade London, if you're looking to engage with London trading, we do this constantly on my mentorship, in the Discord itself. We talk about algorithmic delivery and how market delivers at certain times. 330 macro is very brilliant. 330 macro is very beautiful to give an opportunity using the PD arrays that we're always teaching and ICT is teaching. This time we have an inversion. We have a break of structure down below this low, and the entry towards sell side is a given. Okay, so an example using this model and 330 macro is right in front of you. But of course, started this video talking about a fact where I said it out loud that I was kind of expecting the marketplace to deliver something very, very certain, which is 20,660 and a half. It is 1 standard deviation away for the whole midnight open range, and let's take a look how it delivers later into the day. The second part of this model is of course the AM session and the New York session when the market actually opens up. So if you weren't able to trade London delivery, you're of course going to be able to wake up for New York session. And take a look at what happens here. The marketplace finds a low, taking away the liquidity, resting down below all these lows right here. And the marketplace finds the bottom at what? First displacement of the day, pushing it to the upside, giving us a what? A breaker block right here. Knowing how to use the breaker blocks, we're expecting the marketplace to come back into it and just start pushing us to the upside. Start pushing us to the upside where to? The full standard deviation away from the midnight opening range, right? So let's take a look how the market delivers then. We come back into the range. We start shooting higher, you see right away. Let's take a look at how the marketplace delivers at the 50 percentile level, right? Half standard deviation of the midnight opening range. We shoot through it, and we kind of even give an opportunity for the marketplace to come back to it, running it higher right after. In the marketplace runs. And me here, even the guys on Discord were live during my holiday, and I was able to join in together with them. I called for this not to be the high of the day because people were going short here from this inversion. People were expecting this inversion to happen. They were looking to go short, but I literally said it up like, listen guys, the market is still gonna go higher towards what? Towards the 1 standard deviation of the midnight opening range. Take a look at what happens after. market finds a top and starts trading lower for the rest of the day. Random. You see how beautifully the marketplace delivers, you see how beautifully marketplace consolidates and then starts running lower away from what? From one standard deviation of the midnight opening range. Do you need this to trade? Do you need this to be able to find a position every single day? Of course not. Will this improve your trading? For sure. Go ahead, take a look for it yourselves after finishing this video, after finishing watching this video, instead of just, let's say, being confused, because I very much understand that some of you are gonna find this very hard. Some of you are gonna say, what on earth? First 30 minutes of trading right here is something that I can use throughout the day to find a top of the marketplace. This is how algorithmic price delivery works. This is how ICT has taught me to use algorithmic price delivery. This is how we've been using the price together with time, of course, to find the trading opportunities, to find those high probability setups. So again, to shortly go through what just happened in front of you. First step of this model is to find the midnight opening range, right? It happens the first 30 minutes from midnight open up until the 30 minutes, right? You have extend the Fibonacci extensions towards the have a standard deviation and one standard deviation, which are going to be the two most important key levels. You find the first impulse leg for what? For 3:30 delivery for London traders, and then you're going to use the rest of the extensions for AM trading and AM delivery in the morning hours of New York session, right? So going back into the 3:30 macro and emphasis on time here, New York session explained as well, and my hope is very much that you're going to be able to find this insightful, very much that it's going to be helpful for you to start trusting the price, to start trusting the SMTs that you see, to start trusting the highs or low that the marketplace is creating, and to find those precise high probability entries throughout every single traded day. So if you enjoyed this video, leave a like to this video down below, subscribe to the channel, because we're gonna be releasing YouTube 2025 ICT mentorship review videos like this pretty much every single week. If you're not there, we're live streaming this model and many more that we've been trading throughout 5 years of my experience on my Discord community. So the invite to join the Discord community is down below, and we're just gonna continue on our end going live every single day. A new video is actually cooking while you're watching this one, and I'm gonna stay safe, and remember, nothing random is happening in the price delivery. Bye bye.